webinars every month based on what my clients tell me they're interested in hearing all about. Today what I'm going to do is I'm going to talk a little bit about business tax advantages, but primarily the purpose of this webinar is to introduce you to Kaaren Hall. Kaaren is with a company that she owns called UDirect, and basically what they do is they help set up IRAs. People want to invest in real estate inside their IRAs, their pension plans, and Kaaren is the expert that I send everybody to that's interested in doing that. So I wanted to kind of this is really going to be her webinar, but I'm going to, I wanted to make the introduction. I'm going to talk a little bit about how you're able to really utilize that ability if you have your own business. Pretty much everyone that is probably on this call maybe is self-employed or has at one time thought about being self-employed or has real estate. The way that you keep you hold your business out can make such a difference because it really can enable you to put money into an IRA or pension where you can purchase real estate. So again, I'm Carey Lampel, and I'm going to go ahead and get this started and introduce you guys to the concept of being incorporated, but I'm only going to talk for a couple minutes and I'm going to hand it over to Kaaren. Okay, of course the disclaimer is everybody is different, every situation is different, so just keep that in mind. You'll want to, of course, want to speak with your provider, your tax experts, your tax providers to make sure your circumstance is being addressed, and that's what I want to just put that out there because everyone is different. My background, again, for those of you that aren't clients of mine or don't know me, I have a law degree. I'm a lawyer with a master's in taxation. And also what's called a CTEC, which is a California Tax Prepared License here. So my company is EBS Consulting. We do...
Hi, Carey. Can you hear me?
Yes.
Hi,
yes.
I just wanted to jump in here real quickly. If you like, I can go ahead and I'll switch this over to your screen. I was thinking that we were going to roll with Kaaren first, but I'm going to go ahead and switch over to your screen so everybody can see what you're talking about. So just to let you know. Okay, thanks.
Okay, sorry about that. And anyways, I'm a real estate investor myself, and primarily the people I work with are real estate investors. So that's what we specialize in here, and just wanted to make that clear to anyone. And I'm going to go ahead now and just tell you a little bit about being self-employed here. Or maybe I'm not. Okay, that's, you know what, Ryan, go ahead and switch it over. I'm having some technical difficulties here. Can you go ahead and switch it over to Kaaren? My screen isn't moving forward, so I think that's probably, let's just start with her right off the bat.
Okay, that'll be no problem. I'm going to go ahead and make Kaaren it. Kaaren, can you hear us okay?
Yes, I can hear you. Can you hear me?
Fantastic, sure can.
Okay, real good. So thank you, Carey, so much for letting me be a guest on your webinar. This is great because, in fact, I just spoke last night. Everyone is all about the fiscal cliff, the new taxes. I've been seeing on Facebook everyone complaining about how much less their paycheck is now than it was last year before all these new taxes took effect. And, self-directed IRAs are a great way to pay yourself instead of the IRS. Now, you need tax advice. That's not what I give. That's Carey's thing. And so what we do at UDirect is provide advice on how to self-direct, but you definitely need a tax advisor. You need, you need a good legal advisor and also an investment advisor so that you make sure that you're making the right decision and that you can do your due diligence on different projects. So that's really just crucial, so crucial. I see time and time again when people don't do that, and they're sorry that they didn't. So basically, my name is Kaaren Hall, and I am president of UDirect IRA Services. We opened about 3 years ago, and now we have about 1,400 accounts, and our clients are sitting on over 100 million in assets, and everyone's self-directing, and they're enjoying it and having a good time. Now, the best way to have a good time self-directing, of course, is, like I say, to do your due diligence. Now let's see if mine will go forward. Self-directed IRAs, an IRA, of course, is for retirement, and you know that, but a lot of times it's easy to forget when we can use that money to invest today in things, but it's for the purposes for the long term, and so the IRS always wants to see that you're doing everything for the future, not for getting any benefit today. But when you think about saving for retirement, this is kind of a sobering thought. There's something like a $6.6 trillion deficit between what Americans have right now and what's needed for retirement. That is huge. So you don't want to be in that statistic. You want to be able to save for retirement and do your best that do the best that you can. Now, some extremely oversimplified math here. If you had $100,000 in a retirement account right now, assuming no growth or loss, and you retired at age 59 and a half, and you knew you were going to live till you were 86 and a half, so you took these even monthly payments, you would have just under $400 a month to live on. A lot of people think, wow, I've got $100,000 in retirement, that's pretty good. But you see, people live longer, and it's not a lot. So we really have to plan for this eventuality, and that's what self-directed IRAs can definitely help you do. When it comes to the total retirement funds, actually this number can be updated because I got some new figures when I was at the last conference for the Retirement Industry Trust Association. It's more like $18.5 trillion out there in retirement money altogether. Now, of course, it's broken down in these different categories, but only 3% is in alternative assets. So like 97% could still be self-directed. So if you're trying to raise money for your deals, find someone who has a job, because all you need is active income for the most part to contribute to an IRA, and that person with their IRA could invest with you. So that's something to consider. If you have not heard about self-directed IRAs, you're in good company. They've been around for nearly 30 years, but there are still attorneys and CPAs who don't know about this, and it just makes me giggle when someone says, "Yeah, my CPA says you can't do it. It's illegal." And I say, well, no, it's okay, because this has been allowed since Gerald Ford signed the ERISA laws into effect in 1974. This is nothing new. I mean, there are some people listening to this webinar right now who are older than this rule allowing you to self-direct your IRA, so it is definitely nothing new. So what's the difference between a typical IRA and a self-directed IRA? I get asked that question all the time. The only difference is the asset that the plan can buy. So if you have a typical IRA, it's in the stock market for the most part, stocks, bonds, mutual funds, maybe a CD. But if you have a self-directed IRA, well, guess what? Now you can expand your horizons and invest in anything except life insurance and collectibles. You can invest in rental property where your IRA buys a rental house, your tenants pay the IRA the rent. Your IRA can be the bank. You make a loan to someone, and then they make their loan payments back to your IRA. You can buy stock in a private company, a tax lien, so many different things. It's just a short list of what can happen in a self-directed IRA. So it gives you a lot more freedom of choice and lets you invest in what you know best. Now, just like any other IRA, you're not going to write off any losses, and of course you're going to talk to Carey about the tax issues, but you're not going to write off losses that you see in a self-directed IRA. They're not easily replaced because you're limited by contribution limits. So just know that this is precious money. Absolutely do your due diligence. In fact, if you go to our website, which is the letter U, UDirect.IRA.com, you're going to see some fraud awareness tips with links to 4 different federal agencies that help investors to research their deals before they get into it. So if you're going to put your money with someone you don't know, by gosh, read about them, Google them, Google the principles, and make sure you do your due diligence so that you're making a good investment. Now the limits, again, the IRS, they don't say what you can invest in, they just say what you can't invest in. And this is at IRS.gov publication 590. So they say that you can't invest in life insurance contracts. They have their own tax advantages, and you're not going to invest in collectibles. So you're not going to put like a fine wine collection in your IRA. You're not going to put paintings in your IRA. But if it's for investment purposes, it can go in your IRA. Now, if you are presently working for an employer that gives you a 401k or a retirement account, yay for you. That's great because it gives you another opportunity to save for the future. But you're probably not going to be able to touch that money when it comes to self-direction. You either have to leave the company or get what's called an in-service transfer. And usually if you're 59 and a half, you can get one of these. You go to your plan administrator and you say, look, I'm still working here, but I have this 401k or 457 or 403B or whatever it is. And you say, I'd like to get an in-service transfer, and then they're going to tell you if you're eligible for that or not. So just have that expectation, and you'll have a better experience. Here we go. Here's Pub 590. So it's irs.gov, publication 590, where you can find the guidelines for IRAs. And so we're going to go over the rules here for a minute. But this is just so important Because if you're going to self-direct your IRA, it's really, really crucial to have the right expectations. And here's what I mean. If it's your cash, you can do whatever you want. You can do this, that, with this person, that person. But if it's an IRA, well, there are restrictions that you would never even think of. They sometimes seem counterintuitive. So you need to know the restrictions so that you have the right expectation going in. Number one is you're not going to borrow money from your IRA. You're not going to sell any asset to your IRA that you already own. That's called self-dealing, and it's disallowed. You're not going to use your IRA as security for a loan. You're also not going to use it to buy property for personal use, present or future. So when it comes to investing your IRA, another thing that's important to know is some people are qualified and some people are disqualified to the IRA. So these disqualified people, primarily they're your lineal ascendants and descendants. Your parents and grandparents and their spouses, you and your spouse, and then your children and your grandchildren and their spouses, all this up and down the family tree there, plus any fiduciary or anyone who's offering services to the plan is disqualified or disallowed. The qualified people, though, these people, hey, they're the ones out to the sides, like your aunts and uncles, your brothers and sisters, nieces and nephews. All these people your IRA can, do business with. So that's something you may not expect. I know I certainly didn't when I first heard about this. So let's put this into practical use. So now you know who's allowed and disallowed. Let's put it into perspective. 3 bullet points of what a prohibited transaction is. Really, I think one of the most crucial slides of the presentation. Number one is that neither you nor any other disqualified person can benefit from the IRA. The only benefit is retirement benefit. So you're not going to have present benefit, personal benefit, indirect benefit. It's for retirement purposes only. So before you invest, ask yourself that question. Is my self-directed IRA, is this investment I'm doing in my IRA, is it for investment purposes only? And the answer needs to be yes. So another thing is that you can't buy, sell, or exchange property between the plan and a disqualified person. So your IRA is not going to buy a house that your daughter owns. Your IRA is not going to sell a house to your dad. You're not going to have your IRA buy a property from your spouse either because they're disallowed. So that's bullet point number 2. And number 3 is that you're not going to be, or disqualified person, including you, you're not going to provide goods, services, or facilities to the plan. Today I got an email and someone said, well, Kaaren, my IRA owns this raw land, and so I want to have this LLC that I own come and improve that land. Well, that could be viewed as an overcontribution of sweat equity. If you own the LLC, your LLC is going to improve the property that your IRA owns. That could be self-dealing. It could be a lot of prohibited transactions. You just want to keep everything arm's length. If you think about that, that'll really help you. Another thing, say your IRA buys like a condo, and of course it needs some work, and you think, well, hey, this is great, I can do this. You're not allowed to swing the hammer or paint the walls or do whatever. It's called an overcontribution of sweat equity. It's disallowed. You can hire third-party vendors, though, all right? And to that note, all expenses of the IRA are paid for by the IRA. And similarly, any proceeds go right back in the IRA. So it's kind of its own little microcosm, its own little world when it comes to expenses and money coming in. But these are the 3 categories of prohibited transactions. Now, before you do a deal, call us and you say, hey, this is what I'm looking to do, and discuss it with us. And we'll say if it seems prohibited or not. You may need a further legal opinion. We can refer you to people that can help you with that. Now, another way to set your expectations properly is to understand the structure. Because say you're buying that condo with your IRA. Well, you might think that you're going to put your name on the purchase contract and sign it because that's what you always do when you buy real estate. But with the self-directed IRA, it's different. You and your IRA are completely separate entities. So the name of your IRA goes on the contract. So it looks like custodian for the benefit of your IRA. And then you don't sign it. We sign it on behalf of the IRA. So the other players in the game are UDirect IRA services. We are your point of contact from beginning to end. We are the people that you talk to. We help you through the whole situation. When I formed UDirect back in 2009, I sought out a custodian to have our clients' money held by. And I was looking at banks, and at the time banks were not, they were falling like flies. I mean, hundreds of them were failing every year. And so I chose a trust company custodian because this trust company doesn't have people depositing their paychecks in there. The custodian isn't making loans, so it's not at risk like that. So this is the structure of the IRA. And if you understand that these are the players, well, then you'll have, more correct expectations about the situation. Real estate, I think, 99% of the deals we do have something to do with real estate. It's a loan to real estate. You're buying a tax lien. You're buying a property. You're buying units of an LLC, and that LLC is investing in real estate. So let's talk about pros and cons, okay? I think the pro of using your IRA to invest in real estate is that, hey, that's where the money is, because it seems like liquidity is really drying up, and there's a lot of money, as I was mentioning earlier, in these self-directed IRAs. But also any gain that comes in is tax-free in a Roth, tax-deferred in a different kind of account. So tax-free, tax-deferred, gain is wonderful. And one thing Carey and I were talking about before we got started is that there are these new Obama taxes that have to do with Obamacare. One is a 3.8% tax on, I believe it's passive income, like note income, that kind of thing. And it's that's pretty steep. But guess what? Your IRA is not going to see that tax because the money is going to flow right back into the IRA. And then when you withdraw, you're paying your regular income tax rate. So these are things to discuss with your tax advisor. But if that's the case, and if you are one of the people that would have to pay that 3.8% tax, guess what? You just increased your ROI 3.8% by doing the deal in your IRA. This is great stuff. Now, with a self-directed IRA, there's no time limit for holding the property. The IRA can actually borrow money. That's interesting because it's not a regular loan. I'll tell you more about it in a second. But there's a potential to earn a larger rate of return on invested capital. And so here's what I mean about that. If you took $100,000 of your own personal cash and you bought a house, say like a rental property, and then fixed it up and everything, and then you sold it later and you came back with $200,000, well, that $200,000 comes back to you. What's the first thing that happens? I mean, pretty much the taxes come off the top, right? And you only have, say, $160,000 left to invest. Well, with a self-directed IRA, in this situation, the entire $200,000, the entire sales price from the bottom line of your HUD-1 at closing, it all comes back in the IRA. There's no tax because it's tax-free or tax-deferred, and you can put the entire amount back to work in the next deal. So you can compound your return faster for that reason. Now, the downside about using your IRA to buy real estate, I think the number one downside is that people have the expectation that if their IRA owns a house, well, then they get to take depreciation and they get to have a tax basis and they get to do this and that. Well, you're not going to do that when your IRA owns property because the tax benefit you get is that the proceeds are tax-free or tax-deferred. So you're not going to write off those things like capital losses and so forth. Again, you are solely responsible for all gains and losses. You are the advisor in the deal, and you're the one making all the calls about what you actually invest in, and losses, again, cannot be easily replaced, so do your due diligence. Now, as I was mentioning, your IRA can borrow money. I was so surprised, having been a residential lender for a long time, that it was an IRA that could borrow money and not an individual. And it's a special kind of loan. It's called a non-recourse loan. What that means is that upon default, the lender can only grab the subject property, not any other assets in the IRA, and not come against you personally. So that's pretty great. I mean, so here's the common misconception with the IRA borrowing money. I get the phone call all the time where people are saying, hey, I am going to use my IRA as a down payment on this house. Wrong. The only way your IRA is going to be a down payment on a house is if you're getting if the IRA is getting a non-recourse loan, because it's not made to you, it's made to the IRA. Not a lot of lenders to choose from with these non-recourse loans, but if you would like, I could send you a list. I have a list of non-recourse lenders. Just email me. My email address is khall, K-H-A-L-L, at the letter U, UDirect IRA.com, and I'll send you the list of non-recourse lenders. Like any loan, it's based on risk, the rates and so forth, the down payment, but you can expect to put a larger down payment than you would normally put on a different kind of a loan. And of course, you cannot personally guarantee the loan to the IRA because you're disallowed to the IRA, but someone who's not disqualified could make a personal guarantee. So there's that. Now, there is a downside, so something else to consider if your IRA is going to borrow money, and that is tax. Oh my, the tax rears its ugly head here, you know. And this is something that's surprising because, of course, an IRA is looked as a tax shelter practically. So if your IRA borrows money, it can incur UDFI, unrelated debt financed income tax. And if you want to understand this better, you talk to Carey, and she can explain it. And so whether or not you should have your IRA borrow money, well, you need to pencil out the deal. What are the costs? What's the return? What can you write off from this UDFI tax? And that's why it's so great to have an advisor like Carey, because she can tell you and help make sense of the deal. Like, should you go forward? Does it make sense? Is your IRA going to make a profit if you do the deal with the UDFI? So definitely you want to get Carey involved in that kind of a situation. Also, if you are running an active business in the IRA, and I'll tell you what, flipping houses can be an active business in an IRA. So you can also run into a tax, and that's called UBIT, Unrelated Business Income Tax. So to find out more about this, of course, Carey is a great resource, but also go to the IRS website again, irs.gov, look up Publication 598, and you can read about these two taxes. I think they were at 35%. I think it went to 39.6%. I mean, it's not a pretty tax. And of course, it would be reported on a Form 990T. That's good to know. But just be aware that it exists and talk to your advisors to get more information before you go forward. So how do you get a house into an IRA? How do you do that anyway? Very commonly, people will call and they'll say, oh, I'm so excited. I put a house in contract. Now I want to open my IRA. Well, that's kind of doing it backwards. You want to first have the IRA opened, because here's how that goes. Here's the timeline, right? You open the account, and we open it the same day. Then you want to move your money from where it is now into this new self-directed IRA, right? So you go to your IRA provider, you go to your 401k provider, and you do the paperwork. They're going to take 14 to 17 days on average to move the money. So if you've just made an offer on the house, first off, wrong, because you want to make the offer in the name of the IRA, but also you've got no money to put in as earnest money. You could always wire a contribution into the account real quick just to have the money there so you can make an earnest money deposit. But know the timeline. So we open the account the same day, a couple weeks to get the money in. But once the money's there, you've given us a direction letter and the supporting documentation. We take 24, 48 hours to get the money out into the deal. So that's about, what, 3 weeks? And that's what you need to expect with a self-directed IRA. So open that account first and get it funded, then shop for a property so that everything is all taken care of ahead of time. The IRA is the buyer, not you. So it's the custodian for the benefit of your IRA. You don't sign the offer to purchase. We get it signed for you here. You give us a direction letter. You give us the supporting documentation. And then when it comes time to close, you know that your money gets wired to closing as usual. You fund, you record, you get your keys. Hopefully your tenants move in right away. They're going to make their check payable to the custodian for the benefit of your IRA, like that. Now, and of course, that that could be pretty long. So what some people do is they'll go get a rubber stamp for their tenants so that their tenants don't have to get writer's cramp writing that check every month. And sometimes it's hard enough to get a check from your tenants, let alone making it difficult for them to have to write custodian for the benefit of your IRA. I mean, it's, paraphrase the actual name of the custodian and so forth. Now, another way to handle this, to make it easier, is to have a property manager working with you on your IRA, because when the IRA owns a property, of course, you're not going to do a lot of you're not going to swing the hammer. If the water heater bursts, you need someone to help you with that. So your tenants could make their check payable to the property manager, and then the property manager would then send the money up to the IRA. So that's another way to handle it. Here's an example of how a father and a son would buy a property together using IRA money. Now, of course, I just told you fathers and sons are disallowed to each other because they're lineal ascendants and descendants from one another, but this is an exception to the rule. So here we've got a father who's coming in with cash, and in this scenario, he's got 50%. The son is coming up with 50% from his traditional IRA. So title reads, the full name of the custodian for the benefit of the son's IRA, 50%, father, 50%, tenants in common. And that's how title would read, and that's how the name of the buyers would read, and that's how the signature lines would read, and all that. So Are they disqualified? Yeah, but before the deal, as long as the dad has no ownership interest, as long as the son and his IRA have no ownership interest, and because it's a new deal, that's why that disqualified person rule isn't a factor in this kind of a situation. But it's after the deal, after closing, that deal comes into effect, kind of a loophole where disallowed people can invest together. But after they close, neither father nor son can ever sell their portion to the other. And of course, after the deal, all expenses are split. So here comes the property tax bill, right? Dad writes a check out of his own personal checking account. He pays half. The son, his IRA is going to pay the other half of the property tax bill. And now it's rent. So instead of having your tenants, in this case, write two checks, one to dad and one to the son's IRA, this is, again, a situation where a property manager would be great. Because it's none of their business, who owns the property or how you're structuring it. Make the check payable to the property management company. The property manager will take the two, will split it up the way it goes. So whatever the pro rata split may be. So just some suggestions about how you could handle that. So when it comes to real estate, it is one asset that has more expenses than any other asset I can think of. So it's always a good idea, if your IRA buys real estate, to make sure you have plenty of money in reserve. We don't have a reserve requirement because it's a self-directed IRA. You're the expert investor. You're the one who's going to make that decision. But if you run out of money, what are you going to do, right? So here are 6 things you can do. Number 1, write a check. Make your annual contribution. So how much is your annual contribution? That's when you call Carey. Hey, Carey, I've got this kind of an IRA. And so it's going to depend upon the IRA type. It's going to depend upon your income. It's going to depend upon your age, even, to, how much you can contribute. Number 2, you could liquidate other assets within the self-directed IRA and then use that cash. Like maybe your IRA also owns some, say, gold bullion. And so if that's the case, sell the gold bullion, use the cash, pay, say it's a property tax bill, right? Now, if that's not going to work, you can also transfer money. So say you still have stocks, bonds, and mutual funds in a different account, sell some of them and transfer and use that money to make up the shortfall. You can always bring on a partner as long as they're not disqualified. And the IRA can take a loan. It would be a non-recourse loan from an individual, because I know an institution wouldn't make a loan like that for a shortfall. But your IRA could borrow some non-recourse money from a third party as long as they weren't disallowed. And if none of this will work, you can always sell the asset. But there's always a way to make up for a shortfall. Now, there's something else out there that it's another tool for self-directed IRAs. It's wrongly called a checkbook IRA, and that confuses people because a checkbook IRA is not a special kind of IRA at all. What it really is an LLC. It's an IRA-owned LLC. And to take it one step further, it's a special purpose LLC. So it's not, you don't go to LegalZoom.com, you don't go to Prepaid Legal and have them write one of these up for you. You go to an expert who understands the fine points of the law on this, and you have them draw up this special purpose LLC. So you've got your self-directed IRA open, it has money. That IRA buys 100% of the initial shares of that special purpose LLC. You are the managing member. You have checkbook authority. Now you can use this checking account that your LLC owns to invest. And you have to follow all the same rules as if your IRA was investing directly. You have to follow all the same Internal Revenue Service rules. And it's responsibility, believe me. With great power comes great responsibility. So before you jump into one of these, you want to make sure you know what you're doing. Because here, so what? What happens if you make a mistake? Well, if you commit a prohibited transaction, there's no statute of limitations on a prohibited transaction. So back in 1995, well, actually this didn't exist till 96. So back in 2000, your checkbook IRA committed a prohibited transaction, and the IRS found out about it today. They could go all the way back to when the prohibited transaction occurred, and they can charge you taxes and penalties and so forth, just like because you owed the tax at that time, and you'll pay penalties for every year that tax wasn't paid, even though you didn't realize you owed it. So, and what they'll also do is they'll disperse your entire IRA to you as a taxable event. It can get kind of ugly. So we're here to help. I mean, that's what we do. So if you have a deal, you want to know, is this prohibited? We have resources, and we can certainly help you to make that determination. I mean, is this something that you should do, or is it prohibited? Okay, so with all that said, there's so much to think about, let's talk about what kinds of plans can be self-directed. So one of my favorite calls that just makes me chuckle is when someone's on the phone and they say, okay, I'm looking at your website and I see a traditional IRA, I see a Roth IRA, but where's this self-directed IRA? So again, understand, and kind of a paradigm shift here, understand that a self-directed IRA, that's all we do. But it's the same as any other kind of IRA. The only difference is the asset that the plan can buy. So the IRAs are the same, and they're all self-directed when you open one with us. So those are all plans that can be self-directed. When it comes to qualified plans, that means an employer plan. And so we don't do the plans that are for companies that have multiple employees. We do the individual K, though. That's for a self-employed person with no full-time employees. But there are other plans that aren't even IRAs. They're not even retirement accounts. You can self-direct a Coverdell, also called an ESA, or Education Savings Account, where every child can receive $2,000 a year, and then you take that money and you can self-direct it into deals, maybe making microloans or buying precious metals or raw land or whatever you want. I mean, as long as it's for investment purposes, it can be self-directed. Also, an HSA, or Health Savings Account. That's really interesting because if you qualify first for this high-deductible health plan, you have to first be able to qualify for the insurance. Then you can have an HSA. Now, whether or not you qualify, you need to talk to your health insurance provider and see if you do. All right, but if you do, the contribution goes in and you get to take a deduction. Again, check with your tax advisor. But then the proceeds inside grow tax-free for life. And as long as you spend that money on medical expenses, a very long list of medical expenses that's on the Department of Treasury's website, then that money comes out tax-free too. So it's tax-free money, very cool for health, for your health needs. All of these accounts can be self-directed. So it's not just one self-directed IRA. It's this entire, well, you've got some variety. I guess that's what I'm trying to tell you. Variety for sure. So how do you self-direct? Open, fund, invest, a three-step process. Fill out an application. We have a $50 setup fee at the time of application. And you give us some other paperwork like your driver's license, a copy of the statement, we know from the account where the money is coming from. We have a $275 annual fee, which is a flat fee, regardless of the number of assets and regardless of their value. It's a lot better than our competitors for sure. So you open the account. Now it's open. Now you fund your account. So three ways really to put the money in. One is to write a check, make an annual contribution. Two is to, if you have an IRA, you fill out our form, you sign it, you give it to us, we sign it, we send it to your IRA custodian, your current custodian, and they move the money over. If you have a 401k or a previous employer plan, you don't fill out our transfer form. Instead, what you do is you go to that plan administrator and you fill out their form, and then they will initiate that, and the money comes over into your IRA. And when the money lands, we send you, it's actually the system automatically generates an email to you, so you know that your money arrived. And then you give us a direction letter. That's our form, just one page, pretty simple, together with the supporting documentation. Like, are you buying a property? Then it would be the offer to purchase. Are you making a note? It would be it would be the signed note. So the direction letter, the supporting documentation, and then 24, 48 hours later, we get the money out into your deal, and now you have self-directed your IRA. So we've gone through a lot of concepts in a short amount of time. I've been doing this for 6 years now, and so it's taken me quite a while to fully understand it. And I'm constantly learning new things, which is nice. There's always something new. It's like, oh, that's a nice, interesting thing I hadn't considered before. So there's always something new. If you'd like more information, contact me. khall@UDirectIRA.com is my email address, and our website is full of great information. And that's, of course, UDirectIRA.com. I recommend you check that out. And so with that, I'm going to turn things back over to Ryan and to Carey. And guys, thanks so much. I really appreciate the opportunity to talk about my very, very favorite subject. So thanks.
Well, wonderful, wonderful. So hopefully Carey will jump back on here. Yeah, and thanks so much, Kaaren. That was great information, and it's always good information to hear. I've heard it a couple times, and I'm always picking up things over time that just always new ideas kind of pop in the head there. But there's Carey there, so she should be able to jump on.
I just wanted to say, tell my clients that are out there, Kaaren is, first of all, her website's incredible. I go on there to look stuff up because and once it gets to the pension side, she's definitely the expert, and they're just so good. The client services they get, I really recommend them. Any client of mine that comes in that wants to get involved in self-directing their IRA, she's my only person I would even consider sending them to. So she's great, and thank you so much. I wish I wish I could really let you guys know how excellent though she is, and the service is great. So I'm going to go ahead and at least attempt, because I only wish that I knew something about technology as much as I do about taxes, and we'll see if I can now do my little portion here of the seminar. If not, I apologize ahead of time, and you can always reach me. But like I said, I spend my time learning taxes, not internet stuff, so I'll do the best I can here. We went through my background a little bit here, so I'm going to just kind of want to stress one thing, and that is that I myself am a real estate investor, and that I think is really, I like working with other investors, going to the investor meetings, and really having an understanding of the big picture when it comes to real estate. So we offer any services to any kind of client, but we really do believe that it's a great way to create wealth, either inside of a retirement account or in your own name. So those are really feelings that we have with regard to real estate, and we want to make sure you understand that we're in the same boat as you guys. I'm going to try at least to just kind of talk about different types of, oops, okay, here we go. People come to me all the time and they want to know what the right kind of entity is for their situation, and there's of course different things. There's corporations, which are broken down into two types. There's an S Corp and a C Corp. All corporations start off as C Corps, and we can make what's called an S election. There's LLCs. There's, of course, partnerships. And a partnership can be something as simple as having your name on title. When Kaaren was given the example of having the father and son, that was actually a partnership. It's a general partnership, but there's also limited partnerships, which are registered with the state. But those are different types of ways to do business. Of course, nonprofits, and then of course sole proprietorships, which I'm not a huge fan of, but sometimes it does make sense because everyone's situation is different. The benefits of the corporations are S Corps are flow through, so the business themselves don't even pay taxes. In California, they're going to pay that $800, but they don't really pay taxes. There are no federal taxes at all. C corporations, the biggest benefit to them is the medical expenses being 100% deductible. All public companies are C corporations. Anyone can be a shareholder. If you're working with expats from different countries that you want to be partners in, shareholders with, you'd have to have a C corp. Only U.S. residents or citizens can own S corp stock. There's also some planning benefits in that they can have different year ends as well. The question I'm always asked is, do I need to set up LLCs? A lot of times people will go to seminars and they'll come to see me afterwards and they'll say, oh, I set up a Nevada LLC or a Wyoming or Delaware or series LLCs, or how many LLCs do I need? I heard I needed one for every property. I'm of the school of thought, keep it simple and inexpensive if you can. Absolutely do not believe that you need a separate LLC for each property. It would be so expensive from an administrative standpoint that your whole profit margin could go basically to owning and having these LLCs. Every time in the state of California, every time you own an entity, figure about $2,000 a year just to have that entity. It's going to cost you $800 a year just for the pleasure of doing business here. Plus there's costs to do the tax returns and bookkeeping. So it really would be cost prohibitive if every time you opened a property or an LLC for every property. Can you imagine having 5-6 properties that you'd spend $12,000 a year? Look at the amount of equity, not the amount of addresses. That's what matters. As far as setting them up in other states, I would say don't do that unless the properties are in those states. You want to have the LLC where the actual physical location of the property is. It's fine to have Nevada LLC if your property is in Nevada, but if it's in California, you're going to have to register that entity here as a foreign entity, and now you're paying for 2 states, as well as an agent for service in that state, and it's usually never worth the cost. So just keep that in mind. Things like series LLCs are not recognized in a lot of states, such as California. They are great if you're in states such as Tennessee or Texas that recognizes them, but we don't have them here, so there's really no point in spending the money to set them up. So just be aware of that as well. Pension plans, again, this is what Kaaren was really talking about, IRAs. Then there's, of course, qualified and non-qualified plans. Qualified plans, it's almost like you need a Venn diagram to explain what pension plans are, because some IRAs are qualified, some pension plans are non-qualified. It overlaps as far as what you can and can't expect. But the bottom line is let us know if you think that this is something that interests you or you want to learn more about, and I'll work with you and we'll send you to whomever the expert is, and they'll make sure that you're doing it and so that you're in compliance and that there's not any problems and anything down the road, that you can just concentrate on spending your money on good investments, because that's what we want you to be focused on. Real estate professional status, I'm just going to hit on this a little bit briefly. I just represented somebody came to me, they were being audited, and we won this week, which is really kind of exciting. They were trying to take a $110,000 write-off, and they were concerned it was going to be disallowed, but we were able to get the entire amount accepted because we were able to prove they were a real estate professional. So again, the one thing that we were able to do is to show a lot of backup. If you are going to be audited, you need to show backup. If the properties are out of state, that's okay, and you can work with the property managers, but you need to show that you are the one that is basically calling all the shots, and that they're basically kind of just, you know, serving as your independent contractor doing what you're telling them to do. So the main thing that we did is we went in there with a bunch of backups with a really good log, and the only took about an hour, and the IRS agent said, you're clearly a real estate professional. I'm going to go ahead and allow you that $110,000 write-off, which was great. My client was saved about $75,000 of taxes and interest and penalties, so he was very happy, and I was happy because we were able to show that the requirements were met, and those requirements being the 750-hour rule, or an hour more than your current job. And there's more to it than that. There's also something called material participation and active participation. If you're interested in learning more about it, please feel free to contact me, and I'll be happy to teach you the requirements. Holding versus flipping, I'm just going to hit on this real briefly. Property that's held should be held in an LLC. If it's going to be flipped, in my opinion, it should be held inside of an S corporation usually. Now these laws have changed, obviously, as with regards to capital gains. If your income is over $250,000, if you're married, there's additional taxes. Kaaren mentioned also that 3.8%. There's also an additional 0.9% on top of the Medicare tax, which is actually can bring your capital gains rates on long-term holds up to 25%. Prop 30 made California also increase its. We don't have capital gains rates in California. We just have a higher tax base that goes all the way up to 13%. So be aware of that as well if you're thinking of selling some property that you've held for either a year or more, or even less than that, because then you're going to be subject to ordinary income tax rates, which have also gone up to the maximum of 39%. Depreciation, basically what that is you're able to write off a portion of your structure. Residential property is over 27 years, so you're able to take 1/27th of that a year. If you're going to be selling it before, then you're going to have depreciation recapture. Depreciation is the thing that everyone loves. It's the so-called what's the word I'm looking for? It's basically the phantom depreciation. You're purchasing real estate and you're getting this write-off, but you still own the structure. That being said, if you don't qualify as a real estate professional, these write-offs that come from depreciation are suspended. You're not able to take them. So keep in mind that a lot of people maybe don't want to do an IRA because they want to have the real estate tax depreciation. You may not even be eligible to take that anyways. If you make over $100,000 a year, you're going to be limited, and if you're making over $150,000 a year, you're going to be limited as well. So please keep that in mind. And again, everyone's situation is different. Ask us. That's what we're here for, to answer the questions and to know whether or not you're able to take those write-offs. Okay, again, I'm Carey from EBS Consulting. We've got other tax preparers here. We are here to help you. That's our job. We try to get back to you right away. So please feel free to call us or contact us. Let me see if that's our office right there. Again, here's my contact information. It's kind of hard to see our website. It's a little bit gray in this card, but it's EBS Consulting Inc. That's inc.com. Our number is 760-692-0242, 760-692-0242. Always free consultations. Please feel free to ask us the questions. That's the best way so we can answer for you. And visit us or send me an email at Carey@ebsconsultinginc.com. I can put you in touch with professionals like Kaaren and hopefully address any issues you may have. But thanks you guys for giving us this time during your lunch, and we'll try to do another one next month for you. Let me know what interests you, and I will find the correct professionals to address it. And have a great day, and thanks, everybody.
Carey, we had one question for you too,
Sure.
and this is in regards to basically the title that went out to everybody. What's the biggest difference between, and why is this country so good for the small business owners versus the W-2 wage earner, and why is starting a business, why does it have such big tax advantages versus a W-2 person?
Sure, that is a good question. The main thing is that our country, in my opinion, it's designed, they want you to own your own business and they want you to own land. Not going to, that's obviously a huge question that could take hours to answer, but the main thing is when you have your own business, you can control what your salary is, and as long as you're taking a reasonable salary for what you're doing, you're able to, if you have a corporation, to take dividends out of a corporation, and dividends are the profit of the company, and they're not subject to payroll taxes the way that your salary would be. So if you took $1 out of salary and $1 out as dividends, that salary is going to pay payroll taxes, which are going to be almost 15% higher than the $1 in dividends. So again, as long as you're taking out a reasonable salary, you can make it so that if you have a corporation, you can do lots of tax planning. You can set up pensions for yourself, where you can do things like invest in real estate or the stock market, whatever you want. Those are advantages, and there's just a lot of benefits to having your own business. The government realizes it's a big risk to go out on your own, and they do reward that with a lot of great tax planning strategies, and that's what we encourage. So certainly there's things you can do if you're not self-employed and if you're a W-2, but there are also, is the point of this webinar, there is a lot you can do if you are self-employed. I hope that answers that. Does that kind of answer your question?
Yeah, that's great. Thank you. Thank you.
Thanks, you guys.